Okay. Thank you very much. What class? Okay, fine, thanks.
Hello, all of you. Hello. Good afternoon, everyone, and welcome to today's webinar. We would like to take this opportunity to thank each and every one of you for setting this time to be part of this important training. I'm Ronald Keter from Energy Efficiency Department here at EPRA, and I'll be your host for today's webinar. Maybe we shall give people additional 2 minutes to join, and thereafter we shall kick off. Thank you. Isaac Ndereva, habari?
Mzuri sana Njeru. Can you hear me?
Yeah, I can hear you.
Oh, si unasalimika basi.
Good afternoon once again. I think now we have a few more members who've joined, and I think we can start off our webinar today. So first of all, let me apologize that we had to change in our invitation, we had indicated that this webinar will be on pumps and pump systems. However, the gentleman who was to take us through that particular subject was held up in some other emergency issues. So we've had to change the topic for today, and we are going to tackle financial analysis. For this particular topic, we have our own engineer, Ignatius Chirchir. He's an expert in this particular field, and he has been not only doing it for more like professional end of it, but even for our personal advising people within this department and the directorate as a whole. So without so much ado, let me invite Engineer Ignatius Chirchir to take us through the financial analysis that is necessary to consider when evaluating the energy conservation measures that you propose as part of undertaking this energy audits. Welcome, Engineer Ignatius.
Thank you, Keter. I am audible enough, right?
Yes, we can hear you.
Okay. So I have seen Dr. Engineer Phoenix Musonia. I think it will be against the protocol if I continue without inviting him to say hi. Daktari, kuja usalimie watu. Prof, maybe he just dropped from the meeting, but once he joins in, I'm very sure he'll be happy to interrupt the presentation. So today we'll tackle something on financial modeling. Let me share my screen and see if you can. Are you able to see my screen?
Yes, we
Yeah,
can.
yes.
Yes, we can. Yes.
Nice one. So today we'll do a little bit of financial analysis, which we've interacted with mostly as energy practitioners, energy auditors, or some of the things here we've done them in school when you are doing like engineering or financial engineering or economic engineering, whichever the name it was used. So there are basic things that we normally use them in our daily lives. But when we come now to conducting an energy audit or doing an energy audit, they matter a lot, especially when you are trying to build a business case and show the investor or the company that the recommended ECM or recommended energy conservation measure is worth investing. So the outline of this presentation is a little bit of an introduction, and then now we'll go deeply into developing our business case. In that process, we go also to the financial and cash flow modeling of projects. And in this case, we are concentrating on ECMs, and then commercial feasibility analysis. I'll touch a bit on capital pricing model. And then we will see now the lender's perspective, which in my case, I call it the bankability. of our ECMs, because the lenders are really interested to see if they are able to recoup their investment or earn revenue from the ECMs that you are proposing. So we have the investor's perspective and then the lender's perspective, which you will have a keen look at. So, so you are free to interrupt in case you have any question, in case there is something that is not clear, or if I'm trying to go against the laws of physics and saying something that you clearly know it's not true, then you can raise your hand, and I'll be happy to listen to your comments and even question and address them. So why do we normally do an audit? I'll begin. This is a beginning point. Last year, when we were doing some webinars on quality of energy audit reports, Phoenix talked about the reasons why we really do an energy audit, and he was really emphasizing on the areas that needs to make the energy audit reports. We call them quality energy audit reports. So in this case, he was mentioning something on engineering rigor, the identification of patterns, and maybe determination of areas of improvement as part of the energy audit process that we normally do. So I'll focus mostly on developing a business case from the ECMs that you've done. So my presentation will be picking up from the point where you have arrived at sound energy conservation measures. By sound means the best energy conservation measure that was available to sort or to address that particular issue. So how do we do the commercial feasibility of that project now to see if it makes sense in terms of investors' point of view? So in developing a business case, there are some aspects that you need to consider. First is to confirm if that project is worth like implementing. That is the first point. So there's no point of doing a financial analysis of a project which you know it is not worth implementing. So it's a waste of time. From the onset, you need to know like this project is really worth implementing from the technical aspects. You've gone through all the assessment of the project and recommended an ECM which you believe yourself that if implemented, it can earn revenue or it can have some savings to the facility. So here, to develop a good indicator that the project implemented delivers value for money, as I had said. So you need to do a reliable feasibility assessment that allows the company to make an informed and defendable decisions. So most of the time when you go to do an energy audit, you realize that some of the ECMs are capital intensive and they need like board approval or people in high hierarchies to put their revenue there or to include it in the budget plans. So you need to have something that when it is presented, they see value and they see sense in investing into that project. So here, our point here, when you're doing an energy audit, you want to reach a point where we establish the basics of the project contract that can be refined afterwards in the later stages. So we are not saying like you need to do 100% of everything that the report will be implemented as it is, but you can build on something that can be refined a little bit, and it can come to like to the real life case scenarios where it can be implemented as it is with the minor adjustments. So the project is considered technically feasible, considering the technological assumptions and any outstanding risks associated with the technical requirements. So I'm assuming by this stage, by the time an energy auditor has given an ECM, he has factored in all the technical feasibility considerations that are required. So including the infrastructure designs, the service specifications, and everything. So in the financial analysis and the cash flow modeling, what is it or what do we look at? So if you hear financial model, somebody's doing financial modeling, we've interacted with all these things, but maybe the name sounds like a complex or a complicated thing, but these are just formulas that can be done in a spreadsheet or Excel sheet, if you call it, and you can have an input where if you have your equations or inputs like a project cost, the discount rate, payback period, you can get some favorable outcome from that model. So the financial model is designed to reflect the estimated financial situations of the project during the life of the project or a contract that you are doing. So when we are doing financial analysis of a project, So there are some aspects that we normally make, the assumptions that we normally make. These ones I'll call the macroeconomic assumptions. So these assumptions include the inflation rates, which most of the auditors from the energy audit reports that we normally receive, you factor in inflation. Others, you have the, like say, the interest rates, but to some extent, for example, the interest rate of a project, as you will see in the slides to come. So there are interest rates that should be specific to projects, or energy auditors, you need to calculate the discount rate that you are supposed to use for that specific project. And we'll be having several models that you can use to determine which type of discount rate that you'll be using for that ECM of you've made to check and see if it is if the IRR is positive or is more, or if the NPV is positive, and such kind of things. So why, in this case, do we say that we need to use real terms rather than nominal terms? In most energy audit reports that we receive, some of you use nominal terms or nominal interest rate to calculate the NPV. We need the real interest rate in this case. The real interest rate factors in the aspect of inflation, which has a huge impact on the outcome of the NPV and IRR. So if we ignore the inflation, in this case, you'll realize it will give a distorted figure, which somebody might see the project as if it is worth investing in, but eventually when they invest, they'll never see the returns on their investments. So why are we focusing or emphasizing on using real terms? So real terms account for the effects of inflation, as I had mentioned, providing a more accurate reflection of true purchasing power over time. So contrary to the nominal rate, which doesn't feature in. And then also the real terms allows for consistent comparison of project costs and benefits across different periods of time. Again, the real terms provide a stable basis for long-term planning and budgeting. So you can see, for example, a project which costs 1 million today, and we have an inflation rate of, let's say, even 6%, the one that we have in Kenya currently. Next year, the same project, the same 1 million will have lost value by almost 60,000, which is something significant if it is ignored over or compounded over a long period of time. So these are also some of the explanations that I gave on why we should be focusing on real terms and not nominal terms. The slides will be available also for your reference. I want to move first to the examples that we did, but for the theory, you can always research, and I'm very sure most of us are conversant with what we are talking about. So we have financial analysis of an ECM. Where do we start at? The starting point is normally the capital expenditure. So after you've done the ECM, now we are here to the capital expenses, like what does it cost to install or to implement that project? And in most cases, like for example, the energy audit reports that we have, the capital expenses are not that I can say detailed into other aspects that are ignored. So for example, in this case, we have the construction cost, the cost of insurance, which most of us don't factor in. We have what we call the utility reallocation if there is an implementation of a huge project which you need to move, for example, the underground pipes or some other things in the factory. Those are some of the costings that need to be reflected into the capital expenses. So these capital expenses needs to be as detailed as possible so that you are able to give a true picture, a true value of the cost of investment on that project. And then now in this project, we'll see in this presentation, we'll see the cash flows. We'll analyze the cash flows of the project and cash flows of the investor. And I'll tell you in the next slides what those means. So for capital expenses, we have one common model that we normally use. That is the equity and debt ratio, where people used to fund projects. So and there's a common ratio of 30% to 70%. That is the normal one that is normally used, though some projects can be financed entirely by the investor without considering the debt, but there are some downsides also to that. So in this case, when you are looking for capital expenditure of a project, we normally have this ratio of equity and debt. So the debt mostly is financed by the bank, and this is where we come in now. To make your project bankable is to make it lucrative for banks to want to invest in, to want to give you money to develop that project. So, and what do they look at? For them, there are some aspects that they look at which is not similar to the factors that the investors or the company that you've done the audit look at. So in what I'll mention next is about the difference between the point of view of the investor and the point of view of the bank on that specific project. So for debt, there are some aspects that we see, the level of leverage on how much debt you can take or not. And then we have the aspects of the repayment terms. So those are some of the aspects that determine the level of or the amount of debt that you can take to finance that project. We have the repayment profile, if it makes sense for the company, and of course the cost of debt. So these parameters are determined to a significant extent by requirements imposed by the lenders. You find sometimes the lenders, they dictate on some of these terms. So which includes some things like the debt service coverage ratio, which I'll mention what it means and how you can see, or if you can calculate and see if your project meets the threshold of the debt service coverage ratio that a lender will be willing to finance that project. So under financial structure, the capital expenses, usual structure is a combination, as I said, of equity and debt, where the debt now is the bank loans. And then the level of leverage, the percentage of the total capital required for the project that will be acquired through debt. So, and then we have the debt repayment term, which is the longer the period. Of course, I was saying here, if you take loan, which you normally do, if you take it for a long period of time, you'll end up paying small amount of debt repayment, but the interest will be huge over the long period of time. So short-term loans, you'll realize you'll need to pay a lot of money over the short period of time, monthly, but eventually the interest rate is a bit smaller compared to taking long-term loans. But this one also depends with a lot of factors, including the lifetime of the project and such kind of things. So the loan profile, which I said is mostly different in proportion of debt paid in each period, and it is mostly determined by the lenders. So the common profiles include a flat repayment schedule and a constant amortization, which amortization repayment or equal principal payment. Those are some of the common structures that we normally have in Kenya, where the loan is like amortized over a period of, let's say, 5 years or 10 years, and then you end up paying similar installments or similar amount every month until you complete your loan. So for cash flows of a project, we have two types of cash flows, which I want us to focus today. We have the aspect of cash flow to the project. In this case, it's the cash flow to the investor of the project. And then we have the cash flow to the developer of the project, the owner, and then out to the investor. In this case, the person who funds the equity. Equity is the investor, which is normally the capital expenditure minus the debt. So on the other side, cash flow to the project is the entire amount that is available to service this debt and equity. So we need to check. We need to learn these two aspects and see if the project has enough cash flow to fund the investor in terms of the equity, and also to fund the bank in terms of repayment of the debt. And the equity aspect of the cash flow is very important output of the financial model, as it is one of the central source of information to assess the commercial feasibility. So there are in commercial feasibility analysis of a project, there are two point of views which we need to learn today. That is the investor's perspective and then the lender's perspective. In almost 90% of the audit reports that you normally receive here, we normally focus on the investor's perspective. Like the NPV, we calculate the payback period, something that the investor will be happy to see and actually willing to invest on that project. But from the lender's perspective, they have a different approach. For them, they want to know if the debt service coverage ratio is above their set threshold, and they're able to recoup their investment. Also, they are seeing at the things like loan life coverage ratio of that project. And then we have what you call the project life coverage ratio. So when you present a project to the bank, these are some of the things that they really look at. It's not about saying the NPV is positive, so clearly the project makes money, it's reliable, or the IRR is above the cutoff. For them, it might not matter, but because a project can have a positive NPV, but the debt service coverage ratio falls short below their cutoff mark, and you'll realize they'll not be willing to invest on that project unless there is normally a collateral. So some other projects, you can find the bank are willing to sponsor it if there's a collateral. But in this case, if they are using the project itself as a collateral on its own, then they need to look at these other factors to see if it is really bankable for them. So from investors' perspective, the normal things that we normally do is the NPV rule that you normally know. So the NPV, unfortunately now for the NPVs that we normally calculate, you find that the discount rate that we normally use, I don't know where we get it. Sometimes you find somebody saying, let's take a discount, arbitrary figure. So you need to justify, like, where am I getting the discount rate? So this discount rate mostly should be calculated in there's this model called a capital pricing model, which is a key component of calculating the discount of that specific project. So different projects have different discount rates depending on the risk level of that project. So instead of us using the normal market flat rate of interest rate, which might not give a true figure in terms of NPV, considering the risk of that project. So it can riskier projects, they normally attract higher interest rates. So those are some of the things that we should be looking at when we are assessing the financial feasibilities of a project. That is when you're calculating the NPV, the discount rate. So the cash flows, we should be using the cash flows after tax, of course, and then also use the incremental cash flows, the aspects of the sunken costs that we normally say we just forget them, we don't include them in this case when you're calculating NPV. And then we have so sunken cost, maybe for those of us who are not conversant with the term, the costing, like for example, the one of conducting an energy audit. So you pay an energy auditor. So those are some of the sunken costs that you don't include it in the project, like research cost on a project, so such kind of things, we consider them as sunk costs. And then we have opportunity cost, of course, which has to be included. So all this forms part of the cash flows of that project. So back to the discount rate. When you are calculating the discount rate, and the reason why I'm emphasizing on this mostly is because the discount rates that we normally get from the audit reports are a specific figure, which maybe people take the current market discount rate instead of calculating the discount rate for that specific project. So we know the discount rate as the expected rate of return demanded by the investor. And it depends on the timing and the risk of the cash flow of that project. So as I mentioned, it is always different with projects. There are some projects which are less risky, the others which are a bit risky, so they'll attract huge discount rates. So, and for you to calculate it, then you need to use this capital. I'll mention in the next slide the capital pricing model on how you can move around and find a suitable discount rate to use for your project. So the required rate of return of a project, there are two ways. We have for simple cash, where you use a single discount rate for different cash flows. And then we have now the one where you have every cash flow has a different interest rate. So different discount rate for different cash flows. And the term structure of the discount rate is not flat in this case because of maybe inflation and other factors that are captured. So for capital pricing model, so there are two factors here that we normally use: the risk-free rate, which we can find it from central bank. You can take, for example, the interest rate of maybe government bonds, for example. So that one can be considered something like zero risk. And then we have now the market rate that is given by most of the banks. And then we have what you call the beta of that project. So this beta, for more riskier projects, you find this beta value being bigger value. It can be 1.1, 1.2, depending on the level of risk. So for you to find that value, you can always compare to a beta of existing projects, similar projects, and then you can use now to calculate the interest rate that you use for that specific project. So other tools that people have been using, the conventional ones are the payback period. So this is the simplest one, which people can easily doing the, what we call it, the net cash flows divided by the, what we call it, the cost of the project divided by annual cash flows, and then you know when you will recoup the cost of your investment, as simple as that. And then we have the profitability index or profit investment ratio. And of course, we have the internal rate of return. So NPV dominates these ones, but in most cases, they say this, it is normally wise to use like 2 or 3 some of these decision-making tools to draw a conclusion whether to invest on a project or not. So for payback period, it's annual cash flows, inflows divided by initial investment cost. So the catch here normally comes with the arriving at the figures of the annual cash inflows. So most people for the annual cash inflows, they don't include things like inflation, depreciation value. So you need to depreciate that because the projects or the installation of this equipment, they normally depreciate. So that aspect also, including the corporate tax and all such kind of things. And then, of course, the initial investment, I think, should be the opposite. That is the initial investment divided by, the initial investment divided by the annual cash inflows. So that is when you get now the payback period. So we have those projects which have even cash flows. That one is a bit straightforward. But for those which have non-even cash flows, where this year the cash inflows is different from next year, so that one you might have to do it independently, and then you sum them up and you do the initial investment cost divided by the annual cash inflows of that project. So one limitation of the payback period is it ignores the time value of money, and then it ignores cash flows beyond payback period. You can find small projects are being favored mostly by payback period if you have to use it as the only metrics to determine if you have to invest on a project or not. So you will realize that you have a project with the end life of maybe 50 years and another one is 20 years. The one with the 20 years has a payback period of, let's say, 15 years. And the other one, 50 years, has a payback period of 20 years. So you realize the other one for 20 years, you have another extra 30 years that you'll recoup, you will be earning from it. But this one, you have the end life is 20 years, so you'll have 5 years only. So you'll end up investing, if you have to use the payback period, the one which has a faster payback period, leaving the project that can really be more economical than the initial one. So also in the aspect of risk assessment, it provides limited insights into the risk of an investment since it focuses only on the recovery period. So it has some limitations here. We have also the profitability index. So profitability index or profitability index ratio. So this one is what we call it in initial investment divided by, actually it should be the present value of future cash inflows divided by the initial investment. So if it is more than 1, then you realize now this project can really be invested on. So the good thing with the profitability index is it considers the time value of money, and then it's useful for capital rationing, where now you will decide which project you can, especially if you have limited capital. So, and then the downside is it ignores the project scale. Similar to payback period, you realize a smaller project with a higher profitability index might be chosen over a larger project. So even if the other one has a bigger NPV, you realize the profitability index, if relied upon alone, might not give you a better choice on what to invest in. So profitability index may not always be effective for comparing mutually exclusive projects. So we have mutually exclusive project and mutually inclusive. That one we will mention it later. So we have also the IRR. IRR is a common figure that you know, common term that we normally use. Discount, of course, we know it as a discount rate that makes the NPV equal to 0. And people are saying, okay, the bigger the IRR, the better, of course, the project. And most companies, they have a hurdle rate where IRR value below that one, you will not invest on, they will not invest on that project. So this one also is another metric that most of our auditors are well conversant with. So what we have a problem with IRR, or something my colleague here, Eustace, was mentioning, if a project is has a payback period of less than 1 year, or even let's say 3 years, there's no need calculating or doing the IRR. You find the internal rate of return, you are given almost 800%. So those ones, they are not real good figures to use to make a decision. If it is less than 1 year, 2 years, then no need of computing the IRR. So limitation of IRR, there's multiple projects that have multiple IRRs. So projects with unconventional cash flows. So they normally have, you can find it has several IRRs. So that one, it's difficult to make a decision to interpret, unless, of course, if you use other metrics also in conjunction with the IRR. And then, of course, the scale of investment does not consider the scale of the project, similar to the other aspects. So if we go to the lender's perspective, now we are done with the investor's point of view. Maybe before we move to that part, any question on investor's point of view, IRR, payback period, profitability index? Hello?
Yes, we are still there.
Oh, okay, following. Good to hear somebody is still following.
Just asking that, you know, most of us are used to the Excel version, but here is a PowerPoint version. We're just trying to imagine how we can convert it into Excel version, or what the version that we have is the same one you are saying in presentation mode. That's where the confusion, I am sure many people, because I am not sure whether I am going to change the way I do it today, but I'm trying to see whether what you are saying is what I do. That is the connection I'm making.
Okay, actually the Excel version that you're talking about has the formulas that we are talking about here. So you're building a model from the Excel version. So the NPV that we are talking about is the normal NPV. I don't think there's a different NPV. It is the normal one. Whether you use Excel, whether you use whatever form you use, the NPV is the same from first principle. So I think also that one still works, but the good thing is, as long as you know what you're doing from first principle, that one matters a lot. So you can use whichever software you use. So there are other softwares that have been developed, which is basically a combination of equations and then packaging them in a nice way and calling it in Dereva software for calculating finances. So such kind of thing. So maybe if there is another addition point, then we can proceed to the lender's perspective, and then we move now straight to the interesting part where we discuss the real calculations now using the formulas that you've seen, and also the decision-making criteria from such kind of calculations. So for lender's perspective, which I have called it bankability of those ECMs. So as I had mentioned earlier, they see the debt service coverage ratio. So this one is the extent to which a project's operating profits cover debt service obligations. So each year during the lifetime of the project. I'll show you the formula for that. And then we have now the loan life coverage ratio. So there's a difference here. So this is the NPVs of all the cash flows available for debt service divided by the outstanding debt over the loan period. So you can find a project has a lifespan of 10 years, but the loan that you've taken is 5 years. So in this case here, you'll be using the 5-year period in calculating your loan life coverage ratio of that project. So you are taking the profitability or the cash inflows available to service loans for that period of 5 years and see if it is able to service the loan within that specific period. And then we have the project life coverage ratio. Unlike the loan life now, the project life coverage ratio takes the entire lifetime of the project. If a project is, let's say, it can last for 20 years or 25 years, it considered the entire 25 years, not the loan period. So those are the only differences. But in most cases, you realize that somebody can take a loan of a project at a defined period, saying I'll repay it within 5 years. Others maybe, which is very rare for investor to invest in a project up to the end of life of that project. There are rare cases, but they still exist. So for debt service coverage ratio, this is the net operating cash flows divided by now the loan that you've taken. That is the interest plus principal. So the net operating cash flow. So there is a factor here. So it is the company's revenue minus its operating taxes and everything. That is now the net operating income that you will have that will be able to service the loan within that specific period of the loan coverage. It will be more clearer if we do in the next slide when you do a real case example on what we look at when we are calculating the debt service coverage ratio. So for the loan life coverage ratio, it is the NPVs of cash flows available for debt service. So this one is cash flows available for debt service divided by the outstanding loan over the loan period. So the NPVs of the cash flows available for debt service is only measured up to the maturity of the debt. So, and then the ratio provides an estimate of the project's credit quality from the lender's point of view. So they see like for the entire life of this project, is it able to service the loan? And then we have now the project life coverage ratio, which in this case is the NPVs of all the cash flows available for the debt service in the entire life of the project divided by the outstanding loan over the project life. So we have the NPV of the cash flows measured in the project life. The other one was for the debt life. Let's say you have a loan for 5 years. So we are considering the 5-year period of that project. So, but even if the project can last for 15 or 20 years, you consider only the period where the loan is supposed to be paid up to. So for an example here, there is an audit that was done in a specific facility. So I don't know if it is true. I find some figures maybe a bit exaggerated, but we can see. So we have a VSD that has been recommended by the auditor on several pumps in a facility. So this VSD, they said the total project cost is 2,750,000. Those ones are including all those aspects that we mentioned earlier, saying you need to be very explicit on capital expenditure for that project, the cost that is required, including the construction cost, the design, insurance, all those things. Because if you leave them, you'll realize the project can sound or can look cheaper to implement, but in real case now, when it comes to investing, so it will be undervalued. So if you don't factor in things like transportation cost of taking the equipment, you cannot just say, let us retrofit lights of an entire flower farm, for example. And then you just mention the cost of the bulbs without considering maybe the importation cost if you're importing it, or with transport cost. So all those costings should be factored in as the total project costs. And then we have now, of course, the annual cost savings given as 4 million. So it was around 4 million and some figures there saying this project is VSDs in these pumps. So you have an annual cost savings of around 4 million. So which was very interesting. And then we have now repair and maintenance cost of the VSD. The auditor had at 40,000. So I presume is a specific fraction of the entire cost. And then we have now the depreciation. The auditor mentioned the depreciation over 5 years using a straight line depreciation. So we are saying the VSDs last for 5 years in this case. And then for this case, the auditor mentioned an inflation of 10%. So 10%, I found it quite big. I don't know where he got the figure because from my sources, it's around 6.6 something inflation as at maybe last month or February or something. So the inflation rate, 6.6%. And the corporate tax in Kenya, of course, that was the figure, 30% that was considered. So if you have these figures, all of them know when to see if this project can be attractive to the investor. So you are here as an auditor, you want to do the financial analysis of this one. So here, first thing first, as I had said, you need to calculate the discount rate. So in this case, the auditor had mentioned a discount rate of, I think, a flat discount rate of 20%. We said you can use a discount rate of 20%. I don't know where the figure came from, so without mentioning. So, and also when you are giving assumptions, at least qualify the source. You can say as per the central bank, or as per what, just give a figure there or a note saying an assumption or as calculated by this and this. So those are some of the things that shows like your project can you used figures that you found it somewhere and can be relied upon. So from here now, we need to calculate the discount rate. So for discount rate using the capital pricing model that we said or that we know is common. So we have the discount rate for that project. We have the risk-free discount rate plus the beta of that project. And then we have the return, your interest rate of the market. So using that formula, you can find, so in this case, the risk-free interest rate I took, of course, the auditor in this case did not consider this one. So we took the cost from the central bank, the risk-free, the government bonds, it's around 17 point something %. So I took that one as the value. And then we have now the market, consider the one the auditor gave, assuming it was the market discount rate. And then we have now the beta. So I took like this project, the beta of these projects ranges from 1, which for those projects which are not that risky, up to around 1 point something, 1.3, 1.4, depending on how risky the project is. So that one you can always find from similar projects. You can, of course, it's an assumption you make depending on how risky the project is. So the investors normally, or the banks normally use this figure to calculate how much they'll have as their interest for that specific project. So with all these parameters, it will be easier for you now to have the discount rate. So it was not that far from what the auditor had given here as 20%. So this around 20.6%, but you'll realize it has a significant impact on calculation of NPVs, IRR, and such kind of things. So this is the discount rate that we'll be using in our examples. So the second part for your project now is to calculate the depreciation, annual depreciation. So we said the project has a lifespan of 5 years. So, and it is depreciated in a straight line. So the project cost of 2,750,000 and will be depreciated for 5 in a straight line. So that is the depreciation. So depreciation normally assists you to calculate taxes on what to pay on the corporate tax, because the depreciation part is normally excluded, not included there. So it's like an earning. So if you don't include that one also, you might realize you underquote the significance of your project, because you are not able, you will be giving like a less annual income from the project if you are not considering depreciation. So from the calculations here, the net cash flow is the second part now, where we take the annual savings. In this case, it was 4 million. You remove the O&M and then the annual depreciation aspect of it. So in this case now, earnings before tax is annual cost savings minus O&M minus depreciation. And then now you come and factor in that earnings before tax to the corporate tax. And then now you'll have the net cash flow. So the net cash flow of that project is around 2,907,000. So this is, as you can see here, there is this part here where I came in and added back the depreciation so that you're able to. So it's just used to factor in on what to tax, taxable income in short. So that is the net cash flow of that project. So NPV, from the calculations that we have here, at least at this point, you have all the parameters to calculate the NPV, net present value of that project. So we have our net present value as being around 7 million. So at a glance, decision criteria, assuming we are using only NPV as a decider, Is this in a project worth investing or not? Hello? Hello?
Now that nobody seems to be going for it, I would say if I was making a decision, then I would go for it for the project, given that the NPV is positive.
Exactly. So in this case, using NPV alone, it looks like as long as the NPV is positive, that's the decision criteria with NPV. So as long as the NPV is positive, then you are able to invest on that project. So there are some companies who have like, let's say, a hurdle rate on NPV, like NPVs of not less than this much, we are not investing on that. So those are some of the criteria that you use. So IRR calculation here, I think my colleague Eustace, he knows more about IRR. There's something you mentioned about IRR and NPV. I think this is the right time for you to come in, for me to catch a breath. So Eustace.
Okay, how are you? Can
Yeah,
you hear me?
welcome.
Yes,
Yes,
we
we
can
can
hear
hear
you.
you,
It's
Eustace.
not much I was saying about IRR, but I was saying when you are doing a project, you start by a trial, you check the payback period. Sometimes if the payback period is less than 3 years and the economic life of the project is, say, more than 5 years, you don't have to disturb yourself so much by calculating NPV and the IRR, all those. That's the thing I wanted to emphasize. When you are doing an energy audit, you can save yourself time. You first check the payback period. So you start calculating these NPVs, IRR for a project which has, say, payback period more than 3 years. But if it's less than, you know, within 3 years, you are not affected so much by those changes, risks, and so on. That's mainly what I was talking about. The other thing about IRR, you need to check with the investor himself first, and they see how much profit is he intended to make from that project, because the investor invests to make profit. So the IRR must always be more than the percentage profit. For example, there is no way you can put if the investor wants to invest 1 million shillings and it tells you he wants at least a profit of 25%, there is no way IRR can be less than 25. That's another thing you have to check. I think that's what I wanted to emphasize.
Thank you, Eustace.
Yeah,
Yeah.
if I can
So
just ask a question.
yes.
I'm listening very keenly, and of course, we've been in the market for the last 7 years or so, and I know there are those who have been doing it for more, those who started in 2012. But then we have always had 2 categories of audits, which we call the investment grade and the general comprehensive. But you see, based on what we are saying, we want to say that if you reach at a point where you realize that the payback period is less than 3 years, but the life of the project is more than 5 years, does that then say that even if you are carrying out an investment grade, you don't go to the levels of going deeper into calculating NPV and the IRR?
Yes, in fact, the presentation today is targeting more of an investment grade audit. And that's why I was saying in an investment grade audit, if you find that your payback period is less than 3 years, even if you calculate NPV and the payback period is less than 3 years and the economic life of the project is more than 5 years, if you calculate NPV, it will always be positive. And the IRR will always be good enough. That's what I was saying the rule of the thumb is, even if you are doing an investment grade audit, it's not that somebody just want to see those figures in the report. If you can always say, since the payback period is less than 3 years, automatically NPV will be, and the economic life of the project is more than 5 years. Imagine, for example, like what is the life of, like in government quotas, the economic life of a government vehicle is 5 years. And you find that the work which was supposed to be done by that vehicle will buy another, the vehicle is going to earn a payback period in 2 years. So in such a case, you don't have to spend a lot of time doing that, whether it is an investment grade or a general audit. That's what I wanted to emphasize. Is it clear,
Okay.
Dereva?
Yeah, that's very clear. That's very clear for me. What the other bit that I would have asked is, even as we carry out audits, and we know there are things that are having a life of, say, 15 years. That basically therefore means that even if the payback period is 6 years, it still looks like it can pay back, or rather it is an interesting venture. But we found that most of these facilities, there is no manager who are actually the people to make decisions. There is no manager who normally sees their life beyond 5 years. So they are not keen into getting into an expenditure that is going to pay back in more than 5 years, and they cannot foresee. And most of them actually are those people who are only remaining with less than 5 years to retire. And so they don't engage with research. I don't know whether there is another way they can be informed, because they also go for a very short payback period of, say, 2 years or 1 year or something. Yeah.
Actually,
yes.
Justus.
Before you talk,
Yeah. So
I just wanted to inform Isaac. Most of the energy efficiency projects, by good luck, most of them have payback periods less than 3 years around. But if you find a project has got beyond 5 years, now you have to interrogate it further and calculate the NPV and see it. Because there are some cases where you find the project is saving good amount of energy, but the investments, it's 5 years, more than 5 years. The payback period is more than 5 years. And the economic life of that project is 10 years. So in such a case, you should interrogate it further and see whether it will make economic sense by calculating NPV. In other cases, there are a few cases where you want to invest. There are some projects which you have to invest for more than, which even have got more than a payback period of 10 years, but the economic life of that project is probably 30 years. So in that case, you have to do NPV.
Yeah.
And there are a few projects like that. For example, if I want to change in a cement factory, if I want to change the whole milling process, the whole miller, you cannot get a payback period of less than even 10 years. It will be more. But the economic life of a miller of a cement is more than, say, 20 years. So it's not a copy-paste thing. You have to do your analysis. Once you get the payback period is more than 5 years.
Chichi, before you come in, because it's a final one.
Yes.
There are also projects that we find that they don't have the monetary gain. But for example, if you are talking about a certain component of a boiler, you are talking about saving firewood and therefore saving trees. But sometimes you will find that most of those factories own the forest, and so they don't find a lot of sense in saving that. So in essence, the payback period then would even come to about 15 years. And much as they don't get the credit, they are called carbon credits, because that is the only way of making the saving into a monetary saving. There is also a challenge in that front, but I know it is quite important now that the nation is inclined toward planting trees and the climate change. Thank you.
Okay, maybe to add on what you are saying. So in valuation or economic valuation of project, there are very many aspects into that. One of them, including now that aspect of trying to value, you are introducing an ECM which makes people feel good, or how do you value that? Like they make people in the office like feel more comfortable. So that aspect of valuing the comfort and using it to try and do like the economic valuation or commercial feasibility of that. So there are some aspects also that are taken into consideration when valuing such kind of scenarios where it is not like direct monetary gains, but it is maybe on the aspect of saving the environment, such kind of things. So valuation is very wide, and they have matrices of using that one to quantify the savings that will arise as a result of such kind of measures. So it's not like they are not good energy conservation, or no, not energy in this case, but improvements to the processes, to the facility. So they are very key propositions that you make, but it has a very complex matrix on how you value those aspects. So in most cases, like carbon credits, which I don't know if we have it in our country, but in cases where flower farms, such kind of facilities, they really are keen on those kind of things when they come to like marketing their products. So thank you, Isaac, for your contribution and making at least the presentations lively. So back to our presentation. So we are done with NPV, IRR. So we have of course, the payback period, which is, as I said, it is less than a year, like this one. So you are sure the NPV will be positive if, of course, the project lifespan is more than 5 years. In this case, it was 5 years. So having it as less than 1 year makes the project at least definitely profitable on the onset from that look. So what I'm paying keen attention on is on the initial investment costs. If you are exclusive enough to capture everything that entails the initial investment cost, and on calculating of the annual net cash flows, make sure you have that aspect of depreciation captured in. You have the aspect of O&M, make sure you capture in all those expenditures. That one will have a key contribution to the lifespan of the project. So the profitability index, of course, the formula present value of future cash flows divided by the initial investment cost, and any project that has above 1, so that is a decision criteria people would want to invest in. So in summary, from investors' point of view, so once you calculate the discount rate now here, the NPV, it is positive, of course, you take it. IRR, as you can see, of course, it's big because the project has a payback period of less than 1 year, and the profitability index is more than +1. So in this case, from investors' point of view, it looks like a very good project to invest in. So from lenders' perspective, so you want to take this project to the bank now. You've seen it has all these good things. You want to go to the bank and see if you are able to get some financing. So from lenders' perspective, let's assume a ratio of 70% in debt and 30%. So in this case, they look at the debt service coverage ratio, loan life coverage ratio, and the project life coverage ratio. So for this case, the debt will be around 1,925,000, and the other one funded to equity. Why do you think the equity component is normally given to be a smaller figure than the debt? Why not the other way around? Anybody with a good idea why equity is normally given a small percentage? Justus? Okay, maybe.
I can try, Chichi.
Yeah.
I can try.
Okay.
So in most cases, if you borrow money, it's not your money, and you want to use it for other purposes, and you pay it on a very long period. You'd prefer it than using your own money, which is equity. I think that is one of the reasons. The The other point is about your own financial security.
Mhm. Actually, that covers almost like why equity is normal. People tend to have to invest their money somewhere. Of course, the return also to the investors is bigger compared to the discount rate from the debt. So people tend to say, okay, let me just, the project owners will have the smaller percentage given to equity compared to debt. So from lender's point of view, in this specific project, so we have the net operating cash flows of the project. Net operating cash flows, in this case, we factored in the inflation and of course, the discount rates. So giving us a 2,937,000. So remember, the project was costing 2,750,000. So in this case, the net operating cash flows for the entire project, because the debt, one thing with this project is the debt is to be paid over the entire period, over the entire life of the project, which is not a common case. The project life was 5 years and the loan debt is 5 years. So in most cases, you'll find the project life can be 10 years, but now the loan is serviced within 4 or 5 years. So in this case, you will realize the loan life coverage ratio and the debt service coverage ratio are the same, because you are considering the same NPV of cash flows available for debt service within the same period of time. So, and then now we have the project life coverage ratio, which is the NPVs, of course, of the cash flows available for debt service divided by the outstanding loan. So in this case, the outstanding loan over the project includes the equity and the debt. It's like the entire cost of the project. Of course, you funded through equity. They want to know if you are able to pay your investors and also you're able to service the debt. So these are some of the key criteria or key factors that the banks would want to see from the project. So in summary, from lenders' perspective, in this project, we realized that the debt service coverage ratio is above 1. So for them, that one will make sense. So the debt service coverage ratio and of course the loan life coverage ratio being considered over the same period of time, if it is above 1, then you know you're able to service the loan within that specific period. And then we have now the project life coverage ratio. Also, it's close to 1 there, but at least it's above 1, indicating the project's net cash flow covers the total project costs. So in a case like where the project loan coverage ratio would have been less than 1, it means in this case, we were able to pay the loan, but you might not be able to pay your investors or the equity side. So which might raise a flag, and maybe the investors or the bank would want a collateral without saying, okay, we want a guarantee that you are able to pay us over this period of time. So that marks the end of my presentation, actually, and over lunchtime, after lunchtime, dealing with a lot of calculations, especially finances. It's not everyone's cup of tea. So that's why we really needed to have a short and precise presentation. I'll give more detailed notes on maybe the other aspects of financial analysis or evaluation, including what Ndereva has mentioned on valuing things like environmental impact. So you come up with an ECM, and then now you said this ECM, you realize the monetary savings is less, but there is a huge benefit to the facility in terms of making the employees feel good, or improving the working conditions of the work environment. Those things also, they have a matrix of how you value them, and you include them into the financial analysis to at least entice the investors to be able to invest on that project. So any question up to here? So that is my email. Of course, you can always reach me through that email. And of course, you can call the authority and request to talk to me. I'll be available. So I can maybe hand it over to the moderator of the day.
Thank you very much, Engineer Chirchir, for taking us through that insightful topic on financial analysis. And as we said from the onset, the issues of financial analysis are not only for the sake of our work as energy auditors, but even we can use the same principles in evaluating our day-to-day financial decisions, whether we are trying to work out the options that we have in terms of maybe acquiring as an item, or even calculating your potential earnings from a particular investment. All this, having these financial skills is really key in every aspect. And going forward, as we, upon the publishing of the new regulations, we shall be expecting a number of energy service companies being set up. And this will also present a good opportunity and job opportunities, especially if you have now both the technical skills as well as the financial. It gives you that upper hand in undertaking some of these works, whether it's your own company or you are being employed in such a company. Maybe just to contribute a little bit to the debate that was going on earlier with Ndereva, with regards to, say, the example you gave of tea factories not really paying for the trees, but then as an auditor, it's upon you to work out even the opportunity cost of, say, based on the savings they are going to make in terms of the volume of wood, then that land could even be converted. Then now, instead of planting those trees, you could actually do the actual tea, you could plant your tea there, or they would, over time, the expenditure of now raising those trees, because it's also quite labor intensive, and there's some investment that goes into raising those trees to that level of maturity for you to harvest and use in such an entity. So there's always a way of, even if it's not really, people are not really paying monetary terms, you can always work out almost the equivalent of the same. Let me then at this point open up the discussion, whoever has a question, and I can see Steven's hand is up. Please go ahead.
Thank you, Ignatius, for the insightful presentation. My question is to Ronald. You've talked about the gazettement of the new energy management regulations. Is there an indication on when that will be done?
Okay, we've been in close contacts with our colleagues at the ministry, because then it's the CS who will do the publishing of the same, where as far as we are concerned, everything is done, and we expect anytime from now the same should be published. There's also been a push to have several other regulations that have been pending for a while to be published, and I am very confident that this will form part of those that will be published very soon. Yep.
Great, thank you.
Maybe just a quick one. The same, I like your explanation because it has been valid for the last 4 years. We have always been told that we are almost there, but we had Charles Keter, and then we had Monica Juma, and then now we have Churchill. I'm not sure who was ready to sign, because every time it has been ready to be signed.
Hello, Keter.
So that I can almost say with 90% confidence that indeed this time round, I think we are really very serious about this. And it's because even the push is not really from us as the sector players on this end. Even other quarters are feeling like this really has been we've been waiting for this for too long, and it's about time that we then now move to adopt all these regulations that were stipulated in the Energy Act 2019. So I'm very confident that we shall have this very soon. Thank you.
I see Peter Mushiri. You can.
Ignatius, for giving me a chance to ask a question. Thank you so much for the presentation. At least now I can say I have an idea of the lender's perspective in the bankability of the project that we proposed. I had a quick question. Would you be aware, maybe we have something like simple payback period and discounted payback periods in financial analysis, and maybe where can we apply these in the whole aspect of financial metrics for these conservation measures? Yeah.
Okay, so in this case, we actually, most of the examples that I used here, I considered the simple payback period, because the project that we selected here had like almost how many years? One year payback period, less than 1 year. So the impact of the discounting part on the payback period will be more or less the same. But for long-term projects, you will realize the discounted payback period is the best metrics to use in this case, because you are factoring in also the aspect of the inflation and the aspect of course, the interest rate in repayment of the capital or the initial cost of investment. I don't know if I captured, but I didn't use it here, the discounted, because it didn't have any major significant change. That's why we used the simple payback to bring that comparison.
I think that's clear enough. Thank you.
Okay, next we have Albert Karori. Rocky, please go ahead.
Thank you for the informative presentation. My question was whether we will be able to get the notes maybe through email.
Yeah, we as soon as we finish the meeting, then we'll share the presentation to your mails. I think someone is taking the attendance. So we'll share the presentation and also the live recording if you need to listen to and revisit. I will share it.
Okay, please, if I can, it's just for clarification. I don't know whether you can hear me.
Yes, we can hear you, Isa.
Yes, I had, it's just a reminder. I had like, we were supposed to have a physical seminar or webinar that is physical. I don't know whether it is the next one and when it is going to happen, and whether we have cleared with these CPDs for the online. It's just a clarification I wanted.
So I actually, I wish Professor was around, but because I knew he'd have mentioned that part in his closing remarks, but maybe because I'm still organizing it, let me mention something about it. So we are looking at the week of 10th. That should be, let's say, around 13th there, Thursday, on the week of 10th. So we'll be having a physical one at Strathmore through our partners, of course. Sustainable Energy will be funding the workshop. So we are really looking at a peer review. It's more of a peer-to-peer engagement in terms of energy audit space, the challenges you've been facing, how you'd want us to maybe come in as the regulator and make your process of auditing smooth. Also, we'll be introducing the online submission of energy audits. So during that progress, so we still have that. To answer your question, we have a physical one, a half day in Strathmore, which you are really welcome to come with your comments, reviews. So it will be more of an engagement with the auditors. So one-on-one. So there's no like a major presentation on specific topics, but yeah, it's there. We are planning one on 13th to be specific, but I'll still confirm the date and do a communication to you all.
Okay, then on another one, still on announcements, I think there is a seminar or something around South Sea or something. I don't know whether, again, that is part of what we should attend or whether you have information about it for 2 days, I guess.
No, that one is on maybe Keteria. Where is it on research?
Yes, we shall be having our annual Research and Innovation Week, and for 2 days, that is on Tuesday and Wednesday. This will be happening at College of Insurance, that is in South Sea. So you are also welcome to be part of this, where we shall be discussing on the innovations that are going to be important for the sector going forward.
All right. Okay. Thank you.
Yeah, that one is more of research week, not specific to us, but you will find other, yeah, it's like general research on different topics, including energy efficiency, of course, and other include the petroleum space and all the aspects in the energy sector. So you are welcome, Isaac.
Thank you. Thank you.
Okay.
Okay, Eustace, go ahead.
Okay, this is for information. I think it's good you tell our colleagues, the other energy auditors who are not able to attend. We are holding these webinars in preparation of how to improve our energy audits. And it's going to impact on even as of now, we are going to start evaluating our energy audits. Like from now, it's going to be like we have been doing in the previous. Like for example, if you quote an interest rate now, you'll be expecting you to give all the details, almost similar to what Chilichil has given today. And as you can see, even before, we have been talking about process audits and so on, of which we had noted from the previous audit, we were audit concentrated more on the like equipment audit, or now to move from one motor I1 to I2 or to I3, or how to change from bulbs from fluorescent to incandescent. But as of now, you have to indicate that mostly how it affects the process, how the process affects the consumption of energy in the whole system. So it will be more detail, will be requiring more details on how you arrived into a savings. For example, we don't count it as an ECM. Like if you go and find people are using I2 motors and you tell us change it to I3 motors, it won't be an ECM anymore, because you can change from I2 to I3 and still continue wasting energy. We want to see if this pump, if this motor was driving, if it's a pump or a fan or a conveyor, you want to see the efficiency of delivery of that in the conveyor. So please, let's continue embracing these workshops and take advantage of them at this point, because after this, you'll be required to pay for these seminars. Hello?
That one is not clear.
We can hear you. We can hear you.
Sorry,
that was on a lighter note.
Yeah, we don't like that something touched, especially now that we are having a lot of crop up of taxes. But it is important what we have had, because I'm just trying to wonder of the entrants or the newcomers in this field will be left behind too much. And if you are to assess fairly for all of them, you are likely to reject very many audits done by them. If you are, unless of course you'll be looking at the level of experience, otherwise you need to be a bit lenient to them. Otherwise they will think that you don't want them in that field.
The labor, what do you mean by newcomers?
No, I think I understand what he's saying. Like people who have not done audits before, have not gone through these processes, or are not even part of this workshop, and they are joining as new energy auditors. Of course, as we normally do, our culture, we are not quick to reject energy audit reports. Of course, we'd want for continuity. We'd want you to learn best practices. So as we normally do, and Eustace here is being the champion, we normally invite auditors to hear their perspective, why they arrived at some ECMs here, the conclusion, if they are like going against the norms or our understanding, then we are happy to invite them. And then before we we are like, okay, this report is not meeting the minimum requirements that we need, we normally have a one-on-one, which I believe now, instead of us now rejecting outright from the newcomers, as you have said, then it is wise for us to at least involve them and then coach them as they grow in the industry. And of course, you being one of the auditors who are experienced, so it's also your duty to at least assist others grow in the sector also. They can always consult you. You can be happy to assist and guide them.
To add to what Chirchir has said, Isaac Ndereba, you can hear me?
Yes, I'm here. Yeah.
Of now, we don't expect something like newcomers, because you find for you to be licensed as an energy auditor, you must have at least done 5 energy audits from an experienced energy auditor. Somebody who has done 5 energy audits is not a newcomer, and they must have been trained by Ndereba, unless Ndereba refused to train the person. So we are training now the old guys what they should train the guys who be wanting to be energy auditors, because the regulation is very clear. You must have done at least 5 energy audits. Unless you have been doing them the wrong way, that's when your 6th energy audit, which you do alone, will be rejected. But
Yeah,
still, we will continue with these webinars as long as EPLA Energy Efficiency Department exists. But as you know, the funding for these, the management for these workshops and so on are becoming smaller and smaller, so people will be required to chip in from the pockets. That's why we are trying to do it before things become very bad.
Yeah, I'm saying that because I've been having trainees in the audit, and they of course go through the same problem that we had gone through, where it takes you like 1.5 years to do a report, a graph to center the editing bit of it. You find that sometimes you are doing table of contents and you have graphs and the figures coming to the table of contents. I know it's a very tasking thing for you to organize yourself. So it's not just because 5 audits are not enough for them to do a report completely, but to know the details and the processes, that is enough. I'm not saying that we increase, but I'm saying for them to develop a report and sign off, I took 1.5 years.
And of course, to add on that, Ndereba, learning is never like don't have, you interact with the new systems in the first facility. Of course, we keep learning each and every day. Even you, being one of the experienced auditors, I'm very sure you learn every day, new things, new ways of doing it better. So those are some of the things that we are saying. We will be happy to at least assist and guide. We are also learning on our side. It's not like I have an advantage of probably reading several reports compared to an auditor who's bringing only one. So that gives me an advantage of trying to learn and see which other best practices, which one is better compared to another one. So, but in this case, we are all still learning, including the auditors outside there, also as the authority here. We are also happy to engage you, and also we're happy to learn from you, especially the new technologies and the new practices that you encounter them in the industry. Okay.
And to add to that, we really appreciate the knowledge transfer that do happen through these engagements, whether it's attachments or one-on-one sharing of knowledge and skills that you've acquired over time. And that is precisely why we keep holding these workshops. Not only are we targeting the practicing energy auditors, but also prospective energy efficiency practitioners. And the workshop that we referred to that will be held at Strathmore will not only cover the practicing, but also prospective energy auditors, so that then from the onset they would get an opportunity to know who exactly is in this particular field and how best to then get into it and be a professional in it. Now that I can't see anybody else with a burning question, I assume
I can
Albert.
see Albert has been lifting his hand.
I assume it's an old hand, but just he can confirm.
Sorry, it's an old hand. I had asked about receiving the notes for the presentation. It's okay.
So then if there is no other question, let me take this opportunity on behalf of the authority and, okay. Osia has his hand up. Osia, go ahead.
Engineer is not really a hand. You know, okay. No one has appreciated the engineer for doing some good work. So just to appreciate him for doing some good work. No one has appreciated him. So that's all. Just an appreciation of what he has done. Asante.
Thank you. Thank you. Yeah.
I don't know if there's anybody else. So then let me take this opportunity to thank each and every one of you for setting apart this time to be part of this webinar. And for the discussion that has we've had, I believe at the end of the day, we've learned one or two, or even if we already knew, maybe we've reminded ourselves why some of these principles are important. In particular, let me thank our presenter today, Engineer Chirchir, who has really gone into the depths of this financial analysis, so that then every time that we are doing our audits, and so that we also appreciate the reason why we insist that then you have to do this financial analysis bit, because at the end of the day, we are trying to convert people who are not really believing in the value of energy efficiency, and the language that they best understand is not really the technology per se, but the money. What is it in it? What is in it for me as an individual or as an entity? So that's why financial analysis is a key ingredient in our energy audit reports. So with that, let me thank each and every one of you and wish you a good evening. Thank you very much. Bye-bye.
Bye, thank you.